Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, learn about their experiences through the financial industry. What lessons did they learn along the way? Talk about tools and techniques. What processes did they use to identify investment opportunities? Finally, we'll talk about current market conditions, what ideas, what things stand out as they evaluate the markets around them. Sort of a different structure today a bit with a conversation with Alan Ellman. Alan's the founder of the Blue Collar Investor. He's a longtime educator focusing on the options market. And I had seen Alan a couple weeks ago at the Money Show in Orlando. I'd met him years ago and interviewed him for Stock Charts TV. And I asked if Alan would come on the show again here, and I finally was able to sit down with him today to go through a particular options trade. He's going to share with you a full breakdown of what's called a cash secured put. You may be familiar with a covered call strategy, pretty common defensive strategy using options to protect yourself a bit with downside protection, way to gain premium if you're concerned about an existing position that you have. Similar sort of idea here, but a different structure. The cash secured put. I'm going to allow Alan to describe the particular trade that he currently has on here in mid-November, how he structured it, how he identified the stock, how he looked at the options chain to identify strikes and what levels to use, why this can be an effective strategy, particularly if you're concerned about market downside, which I certainly am here in November of 2025. Please enjoy this great discussion with options trader and educator Alan Ellman, founder of the Blue Collar Investor. Super excited to be chatting today with Alan Ellman. Alan's the founder of the Blue Collar Investor. Alan, you and I crossed paths at the Money Show in Orlando a couple of weeks ago, and I'm super glad to have you on the show today. Welcome.
Great to be with you, David.
No, so I'm familiar with your work from when you and I have spoken before, and you have graciously offered to sort of walk through an example trade, which I think is really helpful. A lot of times when we have conversations, it's sort of very high level, very sort of big picture thinking. Here we actually have an opportunity to get into the mechanics of an options trade. As I'm bringing this up, Alan, the trade we're going to be talking about is called a cash secured put. Can you just describe for those, because I think some of my audience members are very familiar with options. They use trades like cash secured puts, covered calls as defensive plays. Some of them use more exotic option strategies. But I definitely have a big part of my audience that does not touch options, probably because they're frightened to do so. And I'm hoping this conversation kind of lightens the mood and softens them up so they can appreciate it. When you're putting a cash secured put on, what investment thesis are you trying to express, or what would compel you to make that trade before we get into the specifics of this particular one?
Sure. Well, I'm on the sell side of options. So
Okay.
my two go-to strategies are covered call writing and then a
Mm.
similar strategy selling cash secured puts. So as I frame it when I'm doing my presentations, I am the casino, not the player at the slot machine.
Oh,
Because
I
the
like that.
trades start out you're getting paid. Now, when you're selling a cash secured put, you are agreeing to buy the option holder or buyer's shares at a price that you determine, that's called the strike price, by a date that you determine, that's called the expiration date. So we, the option sellers, set the parameters of that contract. And for agreeing to that, we are getting paid a premium. So the first thing that happens when you sell a cash secured put or a covered call for that matter is you get paid. However, David, before you enter the trade, you have to set aside enough cash in your cash account in case those shares are in fact put to you. So the broker wants to make sure that you can afford to buy the shares that you are agreeing to buy. And that's why it's called cash secured.
Right. So, Alan, that's super helpful because what it strikes me that with a covered call and a cash secured put, your equity curve, right, is sort of shaped the same. Meaning, right, the outcomes are kind of similar. You're sort of betting on you're collecting some sort of premium. You have limited but clearly defined upside, but then a kind of a similar downside structure. Is that fair? I mean, there's similar structures between those two trades, right?
Yeah, I mean, if you look at the risk reward profiles, they're
Yeah.
very similar. But the thing about these strategies that a lot of people don't know and understand is that these trades can be crafted based on what's going on in the market today. So, for example, if you're bullish on the market, if that particular stock chart is very bullish from a technical perspective, you may want to be more aggressive with your trades. Or if you're concerned about the market, like I am now and have been for months, you're going to take a more defensive posture with your trades. So, for example, when you're writing a covered call, you could set your strike a little bit higher than the current market value, or you could set it a lot higher and give that stock a chance to appreciate quite a bit. Or if you're concerned about the market, you can actually sell a covered call, agreeing to sell your shares at a lower price and get more protection to the downside. Now, regarding cash secured puts, today's topic, you could set your strike price, slightly below current market value and have some protection. Or in the example that you're about to show your audience, David, you could set it way below and give yourself an awful lot of protection, which is what I've been doing lately. So although the strategies are similar, in a more defensive posture, I prefer cash secured puts.
Got it. So the macro environment really would define in a lot of ways sort of how you would structure this trade. So is there a macro component in terms of how you would structure it versus, or is it more of an individual stock approach that would define how you would structure which one and how you would structure it?
I macro is really important to me because, as a lot of these shares, even the ones that are performing well, can be influenced by either a down market or an up market.
Yeah.
So what I say to myself is this: am I bullish on the market? Am I neutral on the market? Am I concerned about the market? And then that will dictate the percentage of trades that I make that are more aggressive and more defensive. And also relating to your question, absolutely, that individual stock will play a role. Now, I only select elite performing stocks. I mean, an average stock, forget about it. I don't even want to hear about it. Only elite performers. So when it's an elite performing stock in a bull market, guess what? 3 out of every 4 trades I make are going to be aggressive in nature. On the other hand, if the market is down, even if it's an elite performer, maybe 2 out of 3 are going to be defensive. So yes, macro is really important, and then so is actually the individual stock.
Let's take a look at the particular trade that you're gonna walk through for us. Let me bring this up because we were looking at Next Tracker, ticker NXT, but we're starting with what looks like a weekly stock screen and watch list. So I'd love for, as we go through this, how do stocks bubble up onto this particular list, right? How do you sort of get it to that list of names that you're going through?
Yeah, David, this is a screening process that I started 30 years ago. The blue collar investor has been around for 18 years. So, basically the lists that we provide to our members, basically what I've been doing for 30 years. So you can see here, this is our stock screen. We provide this to our members on the weekend. So when the market closes on Friday, 4 p.m. Eastern time, my team starts developing this list based on the screening process that I started way before the blue collar investor ever came into existence. So, for example, I highlighted for your members NXT in the brown row, and you could see here that it's listed as number, it looks like 17 or 12. It's a little hard for me to see.
Yeah, 12.
12 on the IBD 50. So I use a lot of IBD screens as well because I'm a statistics guy, and that's a number, that's a numbers resource. So I use a lot of their screens, but not all of their screens, and I use a lot of others as well. They're all on the top blue bar, how we screen. So I'm very transparent about that. But that's very high on the IBD 50, which means it's a super performer from both fundamental and technical perspectives. Now you could see there the price. That was the price at the time that the list was created, and it's in the energy sector, which is currently ranked A. And it was ranked A last week as well. So that's a big bullish signal as well. Not only is the stock a great performer, but the industry that the stock is in is also an elite performer. Now, if you move over to the mean analyst rating, or MAR, you could see it's 1.8, which is on a 1 to 5, 1 being the best. So the analysts are loving this particular stock.
Yeah.
Now, 1 over on balance volume, you see that up arrow, Dave? That means that more cash is flowing into that stock on up days than on down days. So that's another bullish signal. Now, if you move over to the approximate at the money IV, the implied volatility, look at that implied volatility, 76%. That's huge. Like right now, I would say the S&P is about 20. I didn't look before we spoke, but that's the ballpark that it's in. It's around 20.
Okay.
So it's a very high implied volatility, which is good news and bad news. The good news is the higher the implied volatility, the greater the premiums. Everybody likes to make money. However, the higher the implied volatility, the greater the risk to the downside. So you have to be really careful with these high implied volatility securities. Now, and we'll get to that when we get to the actual trade that I initiated about 8 or 9 days ago. Now, you could see the next column. It says near the money open interest. That has to do with the option liquidity. So you always want to make sure not only is the stock have good liquidity, but also the option, because you may want to buy it back after you sell it. And if the bid-ask spread is very wide with low liquidity options, it's not going to work out favorably for you. So you always want to have very good, solid liquidity, both with the stock and with the option. So we let our members know, hey, yeah, this one does have really good option liquidity. Now, why do we even put that in there? Because a lot of our members also use our list simply for just buying and selling stock without the option component. So if it doesn't have good liquidity on the option side, well, they may say, you know what, I still like this stock. I'm just going to buy it and hold it, or however they manage their stock portfolios. Now, the rest of this line shows that it's been on our list for 3 weeks. So it's been an elite performer for that length of time based on my screening process. So why did I choose this? These are the reasons why.
It's interesting. We're recording this just after earnings season is wrapped up, and there's still, there's Nvidia earnings and other things this week, but we're kind of wrapping up the earnings season. You have earnings indicated here. Is an earnings date something you would just generally avoid because of the binary outcome, or is just a risk that you have to accept if you're taking a trade around that date?
Yeah, I thank you for pointing that out. Avoid it like the plague. And here's why. Covered call writing and cash secured puts are low risk option selling strategy. By adding in the risk of an earnings report, you're converting that to a high risk strategy. So I always, and how did I know to do that? Well, I got bopped over the head back in the mid-90s when I started using this strategy. You know, what happened? All of a sudden, this elite performer dropped $10 in 1 week. What happened? And then I would look, oh, that's what it was. Disappointing earnings report. Or let's look at it another way. Let's say you're doing a covered call on a stock that you plan on holding constantly. Don't cap it with a covered call in case there's a beat, because something like 70% of the stocks that report end up beats. So, don't cap it. So never, ever, ever sell an option, call a put, if there's an upcoming earnings report prior to contract expiration. And that's why we include it in these reports.
No, thanks for saying that, Alan. And I've definitely found that when, because, looking at a lot of charts, when someone points out a chart and something unusual happened and they don't know why. And I'm like, those earnings, you have to be aware of when those dates are. Otherwise you're flying blind. All right. So NXT obviously scans very well. It's on your list, and performance wise, pretty impressive performance here in recent months, right?
Yeah, I like to show our members the price performance of a stock over the last few months, and then I get into more details regarding your favorite subject, technical analysis.
Yeah,
and so you'll see that on an upcoming slide. But you could see here that when I made this slide, that NXT was outperforming the S&P dramatically over the last 3 months. So in addition to the screening process, I like to show this as well.
And then, I mean, strong performance is kind of baked into some of those rankings, right? Because if you're using the IBD system, momentum and sort of price appreciation, accumulation is all part of that. But great to illustrate it. All right, so here we're to a chart. We are now speaking my language big time. What is it from a technical perspective that draws you to a name like NXT?
Okay, well, I've been using technical analysis now for 30 years,
Yeah.
and it's different. It's different than just for stock selection, because with options, if you're doing it, in my humble opinion, the right way, you're going to be using short-term trades. So I use weeklies and monthlies, and I use it for both calls and puts. And the actual watch lists are precisely the same for covered calls and cash secured puts. So if you look at number one on the top, those are the moving averages. So they identify trend. But I don't use simple moving averages, which I would probably use if I was just selecting stocks for a long-term buy and hold portfolio. I use exponential moving averages, which count the more recent pricing more heavily. So you could see, Dave, on the top blue bar where number one is, that's the 20-day EMA.
Got it.
And below that in the red line is the 100-day EMA. And you always want the more recent prices to be higher or better than the older prices. So we like to see that 20-day EMA blue line above the longer term 100-day EMA, which you could see it clearly is. In addition to that, the price bars or candlesticks or whatever you prefer, we like to see them at or above the 20-day EMA. So, once you start using whatever technicals you're using, you don't have to use the same ones I use. But for identifying trend, once you look at that, like in a millisecond, you would say, well, we have a bullish moving average indicator here for NXT. So that's number one. Now, number two is the MACD histogram, and that's both a trend and momentum identifying indicator. Now, I use 12-day and 26-day, but if you set up the parameters, this is stockcharts.com. If you set up the parameters, what you're looking for here by number two, that green arrow, or the blue bars, that's the MACD histogram. So, you don't have to be Albert Einstein here to identify the fact that these bars are, in fact, above the zero line, which is a bullish signal. So we have a bullish trend with the exponential moving averages, number one, and we have a bullish MACD histogram trend and momentum, number two. Now, I like to confirm trend and momentum with the stochastic oscillator. So the stochastic oscillator is that black line, and you could see most recently it was trending up and now is consolidating. So even though it's above the 80th percentile, overbought slightly, I've seen stocks in overbought, and I'm sure you have too, for months and months and months. So right now, I would still consider that a stochastic oscillator. I would still put it in the bullish category.
Sure.
And then finally, number four is volume confirming those other indicators. In other words, if you have a stock that's trend is heading to the moon at a 45-degree angle, but volume is heading 45 degrees the other way, well, that would be negative volume divergence and a kind of a red flag. But in this case, volume is holding up. If you look back over the last 12 months or so, you would say, yep, it's pretty much holding up the way it's been going on all year. So that kind of confirms that the other indicators are for real. And so from a technical perspective, I would look at this chart and go bullish price chart.
I get it. And I love the kind of checklist approach, top to bottom, kind of going through the steps. So we have a chart that's in a consistent uptrend. Momentum is good as measured by some of these indicators. The volume supporting it and certainly not disagreeing with it. All right. Given that as the setup, how do we structure a cash secured put around that chart?
Okay. So getting back to what you asked before was, what about the macro? Well, everybody's got their own opinions about, what's going on in our economy, what impact that can have on the stock market. Well, I put me in the category of very concerned about what's going on. And so I've been structuring a lot of my trades, including this one, in a very defensive posture. Because when you're setting up a cash secured put trade, one size doesn't fit all. Like I've heard people selecting strikes based on delta, based on how many strikes above or below current market value. In my humble expert opinion about these strategies, take that thought and throw it right down the incinerator. Because in addition to selecting the best performing securities, you also want to structure your trade to what's going on today and align it with your personal risk tolerance. Like, for example, when I trade in my mother's account, I'm more conservative than I am in my own account, and I'm pretty conservative in my own account. So one size does not fit all. Okay, so let's get to your question. How do you structure a trade? When I entered this trade, NXT had gone up actually from when we created the report to 106.28. It actually had popped up that day.
Okay.
Oh, stuff happens, right? Now, I'm very concerned about the market. So I knew I was going to select a strike very deep out of the money. That means much, much lower than current market value. So I have a lot of protection to the downside, So what I selected was, I selected a strike that was deep, deep, deep out of the money. And for puts, that's lower. The $90 deep out of the money strike, a 12-day trade expiring actually this Friday, 11/21. And that gave me a bid price of 77 cents. Now, that means $77 for every contract that I sell. Now, David, I do between 100 and 150 contracts every month, between calls and puts, weeklies and monthlies. So what you're seeing here is just a small amount of my trades for the November contracts. Okay, so keep that in mind, because the actual dollars is not critical, but the percentages are extremely critical.
Okay.
So I collected on these two contracts $154. That was my starting point. Again, price at the time I entered the trade was 106.28, and I went to the 90 put strike for 77 cents. Now, you're going to see, I'm pretty sure I showed a slide of my spreadsheet, which shows that protection to break even is 16.04%. That means that the price of the stock can drop by 16%, and I still will not have lost a penny on this trade. And that is critical to using cash secured puts in a very defensive way. But because of that high implied volatility that we looked at before, we could still generate significant premium and have a lot of protection to the downside. And you're going to see that coming up.
Very interesting. So I love it. So by selecting a strike that's deep out of the money, well below the current price level in this case, you've got a lot of room for the stock to move down, but still be able to collect the premium up front. This is a very zoomed out version of your Excel spreadsheet, and you'd mentioned it seems like almost a legendary spreadsheet you've been using. Talk to us. What are all the components that go into these into the calculations?
Okay, I'll go over it, but I want to just tell your viewers that, boy, we really needed that protection to the downside.
Okay.
Because technology took a big hit ever since I entered that trade. But okay, that makes it even a better example than if the market was just kind of going along in a consolidated fashion. Okay, so this, David, is the spreadsheet. I've created about 12 different calculator spreadsheets over the last 30 years. This is the one I'm most proud of. The spreadsheet itself has over 2,400 formulas inherent in this spreadsheet. Now, you can see the top portion is for covered calls and the bottom portion is for cash secured puts, but they're the same. So if we go through where I have things numbered here, number one in the blue cells on the left side is where you enter your trades. So you're going to see that coming up. I can't show you with entries looking at the entire spreadsheet. You'd never be able to read it. But what I'm going to do is I'm going to piggyback that number one over number two. Now, number two is the initial calculations. So how much are we generating in terms of cash and in terms of percentage when we enter this trade? Per trade in the white cells, number 3 is per portfolio, because the spreadsheet will also combine all the trades in your portfolio. Now, the middle section is what makes this spreadsheet different from every other one anywhere in the world, to my knowledge. Number 4 has over 20 different exit strategy adjustments that you could make with your trades. For example, you may want to roll down, roll up. You may want to close the trade. There are over 20 different adjustments you could make in that blue area, number 4. And
Okay.
number 5 gives you your post-adjusted returns per trade. And then number 6, your post-adjusted trades per portfolio. And finally, number 7 is a trade journal, because there's no better way of learning how to become a better trader and investor than to learn from your trades. So you can make a comment. Well, the market went down because the Fed made an announcement that disappointed and the whole market went down. Or you could say there was a surprise announcement. And then you can go back and look at your trades and you can learn from them and become just better and better and better at. That's what I did. So that's the spreadsheet. What your viewers are going to see now, David, number 1, piggybacked on top of number 2. And I think I might have shown the number 3 as well. Okay. So here we go. NXT 106.28. We're looking at the top row now. The $90 deep out of the money strike with a premium of 77 cents. And I took on 200 shares of obligation to buy 200 shares of obligation. Now, the spreadsheet on the bottom row will create the following calculations. It's if taken through contract expiration, circled in red, is a 12-day trade. Now, if we move over to the red arrow in the yellow cell, it shows you that the break-even price point is $89.23. When I entered the trade, the price was $106.28. So look how much leeway we have before we start losing any money. Now, as I said to you before, the technology has been on a roller coaster ride, but lately mostly down.
Yeah.
And NXT has taken a big hit as well. When I checked before we created this discussion, it was about 92.50.
Oh, wow.
So
okay.
even though the stock has gone down almost $14 a share, I am still in a winning position, and I still have a little room to go over the next 3 days. But take a look in the brown cells. You could see what the actual time value return from a percentile basis is. It's 0.86% based on a 12-day trade, annualizes out to 26%. So if somebody said to you, what do you think about a trade where you can annualize that to 26%? Most people would say, I'm in. I mean, can you get a CD for 26%? And with all that protection, how much protection? Look in the purple cell. Protection is 16%. So if the price does not go down below 89.23, we made money. That's it. So this is a classic example of how selling a deep out of the money cash secured put can put you in a position to make significant returns. You're not hitting a grand slam home run.
Yeah.
Using these strategies, if you're looking to hit a grand slam home run, these strategies are not for you.
Yeah.
Okay?
Yeah.
But if you're okay hitting singles and doubles all day long, these strategies very well may be appropriate for you.
And I think what you're demonstrating here, right, by thinking of it on an annualized basis, a bunch of singles every week in, week out can turn into a pretty decent return at the end of the year for sure. So here you, as you mentioned, you put on trades. So with your service, Blue Collar Investor, I mean, I'm assuming you're actually making these trades and then sharing, here's what I'm doing and here's why. Is that true?
Yeah, I mean, I can't possibly show all my trades. I told you before, I do between 100, 150 contracts every month. But what I do is I show some of them. And when I show them, it's when I just entered them. So, I don't know which direction it's going to go. But also remember that when a trade turns against you, we have all those exit strategy opportunities to mitigate losses or even enhanced gains, because if you have a maximum return that you can get with a trade, does that mean you can't get more than a maximum return? You can. You can get more than a maximum return if you know how to manage your trades. So that spreadsheet that we looked at before, the trade management calculator, that's I wrote a book based on that spreadsheet. It's called Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. And that book has 27 chapters of exit strategy information. So once you enter your trade, calls or puts, whatever it is, that doesn't mean you should then curl up into the fetal position and start praying, because you could manage those trades, good or bad. If it turns against you, you could mitigate those losses. If it turns out way better than you anticipated, well, maybe you can get better than a maximum return. You could roll up a cash secured put trade if the price of the stock goes to the moon after you entered the trade. So there's so much you could do to manage those trades.
It's so helpful. And I'm glad you mentioned your book, Alan. You've written a number of books. We'll definitely put a link to that one, because that's one I reviewed in preparation for our discussion. And I love that. I think a lot of people probably feel locked into some of these trades, right? You sort of setting this trade up, but you've literally written books on exit strategies as you go along. I'm curious having worked with people just starting to learn options and trying to learn from your success, what are the mistakes that people make, or what is it that you're trying to help people get through to be more successful in their options trading?
I would say one of the biggest mistakes is that investors start too soon, before they're really prepared. I tell my demographic when I started, that's why I called my business the blue collar investor, or retail investors. But as it turns out, we have a lot of professionals following my work as well. But my focus is on the retail investor, and they get very excited, when they hear about, hey, is this real? You get paid? You get paid for agreeing to sell your shares? What am I missing here? Well, that's what you got to find out. What are you missing? Because because if the price of the stock, there's always going to be a break-even price point, like I showed you before.
Yeah.
But if the price of the stock drops below your break-even, calls or puts, you could start losing money. For example, with covered calls, you buy a stock at 48, you sell the out of the money 50 call for $2, your break-even is 46. So if the price of the stock drops below 46, you're losing money. So you have to know how to take care of it. So biggest mistake is starting too soon, before you're educated, before you paper trade and practice a little bit. And I have another one for you, Dave.
Yeah.
Because I've basically been so fortunate to be in contact with thousands of covered call writers and put sellers all over the world, really. And one of the other big mistakes they make is to go for the premium. So let me find a stock. Let me find a stock that has the best premiums. What does that mean? That means the stock that has the highest implied volatility. Some stocks have modest, go up and down a little bit. And then some stocks like crypto, or, some of the gold or uranium, they go high, they go low. It's a real roller coaster ride.
Yeah.
You do get great premium, but you have a lot of risk to the downside. So that's another mistake. Make sure, maybe that does in fact align with your personal risk tolerance, then okay. But at least be able to evaluate whether that particular stock aligns with your personal risk tolerance and is right or wrong for you and your family.
Oh, that's awesome, Alan. Two really good, thoughtful responses to that question. And I 100% have heard from talking to people trying to learn options, echoes of those mistakes that you just mentioned. All right, final question, and arguably the most important. You have the very traditional background before you got into trading options of dentistry and working in the dental field. So what's more challenging, pulling teeth or writing covered cash secured puts?
I've been so fortunate to have had two careers that I love. And when you love something, like you're really, really good at what you do, including hosting these discussions.
Thank you.
When you're good at something, there's no downside. You just love it. And I loved being a dentist for the years that I was a dentist. And then I wasn't really looking to change careers,
Yeah.
but it just kind of fell into my lap. And then I had to make a decision, and I sold my half of the practice to my ex-partner. I did give him 2 years notice. So, um, but I didn't find either one very challenging. I love doing dentistry.
Yeah.
And then if something came up in dentistry that I didn't feel like I can handle, like a real impacted third molar that was really challenging, there's a whole world of oral surgeons out there.
Yeah.
But so I basically sent those out. But and teaching these option strategies. I mean, I have binders this thick, testimonials. I mean, that alone, even if I don't make a penny on this, is worth the price of admission, the feedback that I get. So this is a hobby for me, really, even though it exploded into a big business. But I just love what I do. And, I'm honored to be part of your programming here. And thank you for the invitation, David.
For sure. No, I'm. That's a huge transition from what you did before, what you're doing now. I think thousands and many more options traders have benefited from you making that career shift. So, on behalf of all of those, on behalf of our viewers today, thanks so much for sharing your expertise, and today especially sharing some great words of wisdom, but also really thoughtful description of a particular trade. I think they're all going to appreciate it. Thanks so much, Dr. Alan Ellman. Great to see you today.
Thanks, Dave. Take care.
I thought that was a great discussion. Thanks again to Alan Ellman coming on the show today. Really appreciate when guests are willing to profile a specific trade from start to finish. And it's actually not quite finished because he still had the trade on at the time we were talking here in mid-November. But I really appreciate Alan's willingness to share sort of behind the scenes look at how he's identifying opportunities. And what I really appreciated was this breakdown of what's called the cash secured put. Again, I'm really familiar with the covered call strategy. That's used often, and I often hear that brought up as a way to use options if you have an existing position and you want to protect yourself a bit. Great way to gather premium, and you can give yourself some room for the market to move against you. But the cash secured put, sort of a different strategy, using the put side of the options chain to again gather premium, and even when the stock goes down, you actually have an opportunity to remain profitable. Really thought that was interesting, seeing the spreadsheet, all the details about what goes into his decision-making process. But did you catch what I would argue maybe the most important part about that spreadsheet? That far right side was the trading journal. What he said, and I'll paraphrase, was basically every options trade he puts on, he puts comments in there to remind himself what he did and why. And then as he closes the trade, impressions about that. And what he mentioned was that was entirely designed so when he goes back and reviews his trade, he can really have the complete picture to consider. That idea of journaling, of having a trade journal, and then having an explicit time where you go back and think about learning lessons from trades, particularly that did not go particularly well. I thought that was brilliant. I'm so glad that Alan made a point of that. Really appreciate the idea of an option strategy that is designed to help you in a bearish market condition. If you're concerned about the macro conditions, how to use options and how to think about structuring the trade a little differently if you're more bullish or more bearish on the overall market conditions. I really thought that was interesting. And Alan literally wrote the book on exit strategies for covered call writing. So I appreciate him talking about the risk side, how to think about giving yourself more room in a volatile or in uncertain market conditions. Great discussion there. Thanks again to Alan Ellman coming on the show today, going through that trade and how it was structured, sharing some of the combination of macro conditions, fundamental and technical analysis. And I would wholeheartedly agree with his technical take on the stock that we discussed and how to think about it in terms of a checklist. By the way, if you want to learn more about technical analysis, be able to create your own checklist that you can use to evaluate charts the way that Alan was describing in our episode today, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your decision making between now and year end and for many, many moons beyond. 3 great benefits of the premium membership. First off, we will teach you all about technical analysis and behavioral finance through our courses, our virtual courses, which are at your own pace, on demand. Second, our premium member only reports like our weekly flight plan, which we just put out over the weekend, lessons we learned from the previous week, key levels, patterns, and signals we're looking for in the week to come. Finally, you'll have full and immediate access to our member-only community where you'll be able to ask questions. I'm in there every day answering questions from our premium members. You'll be able to learn from other people's questions and reinforce some of the tools and techniques in technical analysis. If you want to learn more about the premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 30% off your first 12 months on any plan. That'll do it for today. From Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.